So is the question more about what the participants actually want and how you deliver it? Because I think there's two things coming. One is there's no question that we have in Europe a regulatory regime which is itching to regulate, and the more mandatory the better. But we also have a situation with under Dodd-Frank and EMIR where we're looking to see the OTC derivative market come onto central clearing. And certainly my colleagues who know much more about it than me, is the sad fact of life is there isn't enough collateral for that. So it comes down to a question of, well, where is that collateral and how can it be used more effectively? And again, it's about, is the CCP network, is the CCP supply of services sufficient to absorb what the regulators are requiring comes on to clearing? So again, answering your question, code of conduct. Code of conduct's a very effective way, if you have consensus with participants, it's a very effective way of running market services. Should it be mandatory? Instinctively, I say not. But I think faced with the post-global financial crisis and the regulators' revenge, I see it very hard to understand how we can avoid some sort of mandatory requirement.
Any questions so far? Please, up here.
One question which relates to the Code of Conduct, which is, given the history of interconnection and interoperability in lots of other industries which have the same kind of network characteristics, why do you think the Commission ever thought the Code of Conduct would work?
I think the Code of Conduct was very much a compromise at the time with the Commission, which felt that it needed to do something to underpin the financial services side of the EU, but when it really came down to it, did not want to get into a big regulatory dialogue which would take 5-6 years to complete. And so the discussions at the time with Charlie McCreevy and the various people in Brussels came to the conclusion that if one could achieve a code of conduct that the market participants were prepared to accept, and of course everybody said yes because they knew they could ignore it, then that was infinitely preferable to having regulation. It was a pure compromise. It was a way of saying you've done something without actually having done anything.
I'm delighted with your bluntness. Let's now move on to T2S, okay? And this, again, please, the people at the extremities of this panel, please chip in, okay, sure. if you want to. But this may be again focused on the inner people. What I want to know is, how is T2S changing what CSDs do, and is this desirable? Why don't we start off? Do you have any comment? Jitu, would you like to say something?
Yeah, I mean, some of the comments even on the earlier is linked to T2S, because if we look at European Commission regulators, at the end of the day, what they want to do is that an average man on the street has a good deal, and we need to fix the problem. So if I give specific examples for people who are based in UK, legislation came out that if you wanted to transfer your simple cash from one bank to another, let's not allow the banks to take 3 or 4 days. Let's do it by faster payments. Now, that's around. There are a few players who've actually gone and done it, and it works. You can actually transfer cash from one bank to the other straight away. But there are some banks who still want to sit on the cash, and the person on the street who is not aware of faster payments takes 3 or 4 days. Take an example of a pension fund. One of my pension providers not doing very well. It takes them a month to do a valuation of what the pension value is. Now, that's simply not good enough as far as the regulators are concerned. And I think overall picture is what they would like us to do is to solve a problem for everyone, whether it's netting, saving the cost on equities or funds, settling, clearing, everything that goes with it. So I think some of these infrastructures have been created, maybe mandated for a good reason or not so good reason, is to have that overall cost structure go down. And unfortunately, from my personal perspective, there is still a long way to go. And T2S itself is, if you like, a question. I think T2S is a good thing. It actually allows participants, global custodians as well as CSDs, to look at the model to see how they can serve the clients better. Now, depending on what the political landscape says on Euro, people have a variety of views on whether T2S will happen or not. But that's the fact of the matter. We have to make sure whether you wear a global custodian hat or a CSD hat or a broker-dealer hat or a supplier hat as to exactly how we achieve the ultimate. And I think on the trading side, things have happened. I think we've alluded to that. There is lots of work to be done in the netting piece and the settlement piece.
So G2, as a representative of SWIFT, is still unclear whether T2S will happen or not. I'd like you to say how T2S is affecting CSD businesses. And I know, well, let me just open that question up with you.
Let me go back a step to one of the things G2 said. T2S, the concept of T2S is actually a good thing in terms of getting CSDs around Europe to think differently about their model. The reality of T2S, and I believe it will come, the political will is there to make it come. The reality of T2S is that it's a solution looking for a problem. If we look at the overall costs of post-trade, it is not on the settlement side, and it certainly isn't on the settlement side at a CSD. The real costs and the risks that we have are in corporate actions, they're in income payments, they're in tax, they're in all the asset servicing activities that are undertaken, where we're dealing with 25 different jurisdictions, different languages, different tax rates, different rules depending on who the final beneficial owner is and so on. That's where the cost and the risk is. Even if you're paying the highest rate for a settlement transaction in a European country, and yes, it's more expensive than the US, but the reality is we've got well over 20 countries and 19 different languages and so on. Even if you're paying the highest rate, as a fraction of the overall cost of doing a transaction, even for the retail investor as part of his commission that he pays, it's tiny. That is not the issue. But I could see T2S for European regulators being very attractive in terms of capturing information on flow. That's a different thing.
So, but just pushing it a little bit further and purely on a descriptive side now, so rather than taking a judgment of it, how would you say that it's, repeating the question, how would you say that it's affecting the business models of CSDs? How are they changing or not?
Well, they are being forced to change. I mean, I'm now talking about CSDs in general. Obviously, being a Swiss CSD, I can say, leave me alone.
Exactly.
But
and thank you for taking on a bigger, thank you for taking on
But CSDs, I mean, you think about it, it makes no logical sense to separate settlement from safekeeping and pull apart something that is integrated and say you're now going to do the settlement side 300 kilometers away and then reconcile it back to the holdings that go right back to the CSD where it originally came from.
As you would expect, the sort of business we're in, we're spending a lot of time looking at T2S, understanding it. And I think from the point of view of such a big infrastructure project, and you'll probably correct me that I'm wrong straight away, but I haven't come across a purely politically inspired piece of market project work as this before, because it's less about what the market wants and more about what the politicians want. So again, to answer one of your many questions, what does it do to CSDs? Frankly, I think a number of the CSDs will go to the wall because the costs, it seems to us, of connecting to T2S are not small. And let's be clear, one of the things T2S is about is harmonizing settlement standards, harmonizing post-trade behavior. And one of the things that keeps the smaller CSDs in business is the fact they represent the practices of their home markets.
Isn't it bringing more competition to you in that the CSDs are trying to diversify and get more into your space?
They are, but that wasn't T2S that kicked that off. That was an extra survey a couple of years ago that suggested that if CSDs weren't in our space, they should be. And that provokes a number of reactions, not the least, let's compete.
The panel asked, or the panel member asked a question about the demutualisation process that occurred with the exchanges a few years back, kicking off the demutualisations of the CSDs and CCTPs, etc. And the answer that came back was it probably wasn't a bad thing from you, Ruben. One of the issues that I think about, and I'm interested in the panel's view, is the regulators can be hard taskmasters, but so can shareholders. If the shareholders are looking for profit, how can the demutualisation of exchanges and the CSDs and CCPs do anything other than be a race to the bottom of the barrel?
So, just to repeat, to make sure that I understood your question, you said that we as a panel, or at least me, was in favour of demutualisation, okay? And you then said, you then questioned whether, given that shareholders are very hard taskmasters, forgive me, they will look to maximise profits and thereby race to the bottom of the barrel. I presume you weren't explicit, but in terms of satisfying regulation or providing services or whatever criteria you might be interested in.
More to do with competing with those around them, and in that competition driving price down. And as price goes further and further down for their clients, they themselves become stuck because they can't afford to provide the services their clients are demanding.
It's an absolutely valid point, and it's one that we battle with all the time. Now, the way we've dealt with it within SIX Group, which I actually think is, and this isn't self-serving, just objectively, it's not a bad way to go. We've taken every business line within the group and categorized it along 3 lines, whether it's a monopoly position that's infrastructure relevant, a competitive business but infrastructure relevant, or purely competitive. So for instance, the first category, monopoly infrastructure relevant, would be Swiss Interbank Clearing, the cash clearing side, and SIS for the domestic business. The second category, which is infrastructure relevant but has to compete, the stock exchange and the CCP are clearly in that category. And the third group are things like telecourse and the cards businesses and so on that we run. Each one of those categories has a different approach in terms of how we do pricing. The first category is run on a not-for-profit basis. So effectively what I do at the end of every year, I look at what we need to invest for the future, how has the domestic business done, and we give a rebate back to the market if we don't need the funds for either the capital base or for future investments or whatever. And of course that's not done on the third level where we're purely competing. And the idea is essentially to say we run the businesses commercially, but there are areas where we have a responsibility to the market, and at that market, I mean, our shareholders are our customers, but they're still looking for a dividend, and they're still looking for relatively tough targets in terms of business growth and so on.